If trading were truly an analytical profession, if profitability were purely a function of intelligence, logic, numerical skill, and pattern recognition, then engineers, mathematicians, physicists, data scientists, finance graduates, and every person who prides themselves on their intellectual horsepower would be dominating the markets and quietly compounding their capital into generational wealth. But the world doesn't look like that at all. In fact, the overwhelming majority of highly analytical individuals blow up their accounts just like everyone else. And the shocking part is that many of them blow up even faster than the average trader, because their intelligence gives them a dangerous illusion of control and certainty that does not exist in the market. And the real reason behind this lies in a truth that most traders never want to face. Trading is not an IQ contest. It is a behavioral one, a psychological one, an emotional one, a test of the parts of the human brain that no academic degree can train. And when you truly look at what happens to people once their own money is at risk, you realize that trading is less about how well you can analyze probabilities and far more about how well you can control the deeply primitive impulses that hijack your decision-making under pressure. Think about it carefully. The market gives you endless data, unlimited charts, infinite indicators, limitless patterns, enormous amounts of historical information, backtesting tools, probability models, risk management frameworks, and strategy templates. So naturally, analytical people assume they will thrive. They look at charts and think, I will treat this like a problem to solve. I will follow the numbers. I will trust the logic. I will remain rational. I will eliminate the emotional noise. And then, within a couple of weeks of live trading, they find themselves revenge trading, hesitating, jumping in too early, moving their stop loss, widening their stop loss, taking profits too soon, doubling their position size after a win because they feel invincible, or doubling after a loss because they feel desperate, breaking every rule they set for themselves while saying the classic line, I know what I should have done, I just didn't do it. And that sentence alone is the entire proof that trading is a behavioral game, not an analytical one, because most traders already know exactly what they should do. Their problem is that they cannot get themselves to do it consistently. Most traders are sitting on strategies that actually work. They are not losing because their system is bad. They are losing because they are bad at behaving in alignment with the system. And that gap between analysis and execution is the canyon that destroys the majority of traders. Think about your own experience. How many times have you predicted a move perfectly? You drew the levels, you marked the zones, you identified the pattern, you anticipated the breakout or the reversal. You told your friends, you posted it online. You were right. The market did exactly what you expected. But did you make money on it? Most traders don't. And the painful reasons are always behavioral. Either you hesitated and missed the entry, or you entered and panicked and closed early, or you held too long and watched a winner turn into a loser, or you micromanaged the trade into destruction, or you second-guessed yourself because of your last loss, or you sized too big because of your last win. But in all cases, the chart didn't betray you. Your behavior did. Now imagine a typical trader's day. They wake up, scan the markets, see a setup forming, recognize it instantly as something they have backtested hundreds of times and everything checks out. The market structure is aligned, the risk-reward ratio is clean, the momentum is favorable, the setup is textbook perfect. But right before clicking the buy or sell button, their mind hijacks the moment. Thoughts rush in from past wounds, past trades, past losses, past regrets, bills they need to pay, fears about being wrong again, doubts about whether this time is different, memories of similar setups that failed, the fear of looking stupid, the fear of losing money, and suddenly, the clarity they had just seconds ago collapses into hesitation, paralysis, confusion, and emotional noise that has nothing to do with the chart. And if they do manage to enter the trade, the next demon arrives instantly. Once money is at risk, every tick feels like a threat. Every small red candle feels like danger. Every pullback feels like an attack. Every moment in drawdown feels like evidence that they are wrong. Their heart rate increases, their breathing changes, their focus contracts, their mind becomes hyperactive, and the take-profit target they placed calmly before entering now feels impossibly far away, while the stop-loss suddenly feels too tight, too dangerous, too threatening, and the temptation to interfere becomes irresistible, so they move their stop, tighten their TP, exit early, or convince themselves that taking a small win is safer even though it destroys the entire statistical edge of their strategy. And if the market ends up going exactly where they originally planned, they feel regret, anger, and self-blame, which only fuels more emotional decisions in future trades, creating a vicious cycle of psychological instability that no indicator can fix. The fascinating thing about all this is that the chart never changed. The structure remained valid. The analysis remained correct. The setup remained clean. What changed was the trader's internal state. This is why trading is more psychological than analytical. Because while you can spend thousands of hours studying charts, indicators, order flow, macroeconomics, and strategy design, if you cannot stay in behavioral alignment when your emotions are activated, none of your knowledge will matter. Your emotional brain will override your analytical brain every time. This is exactly what happened to Marcus, a brilliant technical analyst who could see market structure with exceptional clarity. He understood trend behavior, liquidity zones, demand and supply, institutional footprints, and signal construction better than almost anyone around him, and other traders constantly asked for his opinion because his analysis was stunningly accurate. But when he traded with his own money, he couldn't hold winners, he couldn't accept losses, he couldn't stick to his plan. He sabotaged himself trade after trade, not because his analysis changed, but because his behavior collapsed under emotional pressure. When he analyzed for others, he had no attachment, no ego, no fear, no bias. But when his own capital was on the line, his brain shifted into survival mode. His objectivity vanished, his discipline evaporated, and his instincts overpowered his logic. He became self-aware enough to notice the pattern, but knowing the problem did not stop the problem, because awareness is not the same as behavioral rewiring. And this is where traders misunderstand psychology. They think that once they identify their weaknesses, they will stop making those mistakes. But awareness is the first step and the easiest one. The hard part is the emotional retraining required to behave rationally under pressure. And this requires repetition, exposure, and deliberate practice, not just knowledge. Why does this happen? Because the human brain was not designed for financial markets. Your brain evolved to keep you alive through immediate threats, predators, hunger, physical danger, tribal conflict, and resource scarcity. In that environment, hesitation could kill you, acting quickly could save you, avoiding loss was essential, sticking with the group was survival, reacting to fear instantly was necessary, and being wrong had life or death consequences. But trading demands the opposite. It demands patience instead of urgency, acceptance of losses instead of avoidance, independence instead of social confirmation, long-term thinking instead of short-term impulses, probabilistic thinking instead of certainty, emotional neutrality instead of emotional reactivity, and the ability to endure discomfort without acting, which is the complete opposite of how the brain evolved. Losing a trade triggers the same neurological response as physical danger. Cortisol spikes, adrenaline activates, the amygdala takes control. The fight or flight system turns on metsimewot, and when that system activates, your rational thinking capacity shuts down by up to 80%. This is why after a loss, you want to get back at the market. Your brain interprets the loss as an attack and wants to fight back, even though the market is not a predator and doesn't know you exist. This is why, after a win, you become overconfident. Your brain interprets the win as evidence of increased capability and safety, pushing you to take more risk, even though the outcome was just one data point in a probability distribution. This is why decision fatigue destroys traders in the afternoon. Every micro-decision drains your self-control, and by the end of the day, your willpower is depleted, making you far more susceptible to impulsive trades, emotional reactions, and rule-breaking. Professional traders know this intuitively, which is why they limit how much they trade, restrict which sessions they trade, or stop after a few trades to protect their behavioral capital. This is also why two traders can trade the exact same strategy with completely different results. One follows the rules, the other trades based on emotion. One sticks to the system, the other improvises. One executes consistently, the other only takes trades that feel comfortable. And even though both understand the analysis, only one behaves in line with the strategy's probabilistic edge. And this goes deeper. Simulation trading feels easy because there are no emotional consequences, which means you aren't practicing the real skill of trading, execution under emotional pressure. Real trading triggers fear, greed, hope, regret, anger, frustration, pride, shame, and internal conflict, none of which appear in a demo environment. Which is why almost everyone performs better in backtesting than in reality. You can know exactly what to do, but when real money is on the line, your emotional brain fights your logical brain, and unless your behavior is trained, your emotions will win. This is also why simple trading strategies often outperform complex ones. The more variables you have, the more opportunities your emotional brain has to interfere, rationalize, reinterpret, adjust, or manipulate the setup based on fear or greed. Complexity gives the trader more excuses. Simplicity forces discipline. A simple moving average strategy, if followed precisely, can outperform a complex multi-indicator system that the trader cannot follow consistently. Again, the edge is not in the strategy, it's in the trader's behavior. People think psychology means eliminating emotion, but the goal is not to become emotionless. Emotions are part of being human and cannot be removed, but they can be observed, understood, managed, and separated from execution. The most profitable traders feel fear, greed, hesitation, excitement, doubt, and frustration just like everyone else. But they have trained themselves to create space between the emotion and the action, and that space is where discipline sits. Discipline is not the absence of emotion. It is the ability to act correctly, regardless of emotion. Profitable traders have mastered the ability to do the right thing when they feel like doing the wrong thing. They take the stop loss even when they feel like it will reverse. They hold the trade to the target even when they are scared. They avoid taking a trade even when they are bored and want excitement. They size the same even after a big win or a big loss. They follow their system even when the last few trades were painful. Every behavior that leads to profitability is emotionally uncomfortable. And losing traders avoid discomfort, which means they avoid discipline. Behavioral mistakes don't always hurt immediately, which is dangerous. Taking profit early might still give you a win, so you feel rewarded for bad behavior, which reinforces the habit until it eventually destroys your statistical edge. Holding a loser might occasionally work, which creates a false belief that breaking your rules is sometimes smart, which eventually leads to catastrophic losses. Trading success is not determined by individual trades. It is determined by the long-term distribution of trades, and any behavioral inconsistency compounds negatively over hundreds of outcomes. This is why traders blow up after months of doing well. Their discipline eroded slowly, not suddenly. Preparation routines also play a huge role. Traders who do not prepare properly enter the market reactively, emotionally, and without a clear plan, which makes them vulnerable to every candle, every fluctuation, every impulse, and every fear-driven thought. Whereas traders with solid preparation routines already know what setups they want, what conditions they require, what scenarios they expect, how they will react, and what they will avoid. Preparation reduces emotional load, Because decisions are made in advance, in a calm state, instead of being improvised under stress. Position sizing is another behavioral tool disguised as risk management. If you are trading with money you can't afford to lose, you will behave irrationally. And no amount of analytical skill can compensate for the fear and pressure of risking survival money. Trading with money that is emotionally significant creates psychological distortion because the stakes are too high for your brain to maintain objectivity. This is why the advice, only risk what you can afford to lose, isn't financial advice, it's psychological advice. The real traders you admire, the ones who survive decades, all have one thing in common: behavioral consistency. Not identical strategies, not identical indicators, not identical timeframes, not identical risk models, but identical discipline. Analysis varies. Behavior determines longevity. Most traders fail because they put 95% of their attention into analysis and only 5% into behavior, which is backwards. Because once you have a strategy with a real edge, the only thing that determines profitability is whether you execute it faithfully over hundreds of trades without emotional interference. You can't control the market. You can't control whether any trade wins or loses. You can't control volatility, liquidity, spreads, or randomness. But you can control your actions, your discipline, your execution, your patience, your risk exposure, your size, your preparation, and your emotional responses, which means the true barriers to trading success are internal, not external. And while that is uncomfortable, because it means you have nobody to blame, it is also empowering, because it means your success is in your hands, not the market's. Every profitable trader eventually has the same realization. You don't become consistent by learning more. You become consistent by behaving better. And that behavioral transformation is the real journey of trading, the journey most traders never complete because it requires confronting their own weaknesses, insecurities, impulses, fears, ego, and emotional habits. And most people would rather keep searching for a new strategy than face themselves, which is why most traders remain stuck in the same loops for years, not because they don't know what to do, but because they haven't yet learned how to consistently do what they know.